Hey everyone, welcome back to Market Tips, the channel where macro meets the market. In today's video, we're diving into one of the key drivers of current market volatility, tariffs. How do tariffs impact stocks, bonds, and commodities? And which sectors stand to win or lose? Let's break it down from a macro perspective with a sharp focus on market trends, investor sentiment, and sector rotation. So, what's happening? With protectionist trade policies back in focus in the US, tariffs are once again reshaping global trade dynamics. Whether we're talking about China, Europe, or other partners, one thing is clear: global supply chains are under strain. This uncertainty is unsettling investors, and market uncertainty tends to drive volatility, portfolio rebalancing, and capital flight away from trade-exposed sectors like technology, global logistics, and multinational consumer brands. Let's break down the impact across major asset classes. Equities. Sectors with complex international supply chains, like tech, automotive, and consumer goods, are feeling the heat. Think Apple, Tesla, or Nike, where higher input costs and delivery disruptions pressure both margins and timelines. On the flip side, domestic-centric sectors like U.S. manufacturing, infrastructure development, and agriculture are emerging as potential safe havens during trade disruptions. Bonds. As uncertainty grows, investors tend to flock to U.S. Treasuries, pushing yields lower. Meanwhile, investment-grade corporate bonds in domestically focused sectors remain attractive for capital preservation and steady income. Commodities. Agricultural commodities may benefit if tariffs reduce foreign competition, giving a boost to U.S. producers. However, energy commodities, especially oil, remain sensitive to changes in global demand and geopolitical tensions. Now, let's zoom in on specific sectors and companies that are particularly exposed or well-positioned when it comes to tariffs. Automotive. Ford Motor Company, EF. With around 80% of production based in the U.S., Ford could benefit from a more insulated supply chain. General Motors, GM. With significant exposure to Mexico, Korea, and Italy, GM faces greater risk from tariffs on imported components. Manufacturing and heavy equipment. Caterpillar, Kuaitai. Strong U.S. presence but still vulnerable to steel tariffs and global infrastructure demand. Deere & Co. DE. A key player in U.S. agriculture, potentially benefiting if food exports fall and domestic demand strengthens. Agriculture and food production. Tyson Foods, TSN. Largely U.S.-based production could give it a competitive edge in a tariff-heavy environment. Archer Daniels Midland, ADM. While global in scope, ADM is well-positioned to pivot with a U.S.-centric trade strategy. So, how are investors reacting to the shifting trade and tariff landscape? Sector rotation toward value stocks and U.S. resilient industries. Stock picking with a focus on companies with strong balance sheets and localized supply chains. Hedging against volatility through defensive sectors or high-quality bonds. Bottom line, tariffs aren't just policy levers. They're market catalysts. Understanding which companies benefit or suffer gives investors a strategic edge in a macro-driven market. That's it for today's breakdown. Are tariffs a temporary disruption or a lasting shift in global trade? Let me know your thoughts in the comments. I'd love to hear your take. If you found this helpful, hit that like button, ring the bell, and subscribe for more macro-driven market insights, right here on Market Tips. And remember, this is not financial advice, it's macroeconomic insight. Always consult a licensed financial advisor before making any investment decisions.